Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, September 17th, 2024. Welcome back to the podcast, George.
Thanks for having me on, John.
Yeah, good to have you. And it's been a while, at least for me, as I was doing a little summer vacation. But here it is mid-September, and we're back to it. So I guess to set the stage here, what I'd say is it's been a roller coaster of a ride over the last week or so in financial markets. And despite what I'd argue would be a mixed payroll report, mixed CPI data release, the rates market has gone from pricing nearly no chance of a 50 basis point cut to pricing as high as a 70% chance that the Fed cuts 50 basis points at this week's FOMC meeting. Given it's the fall, perhaps we should call this the Super Bowl of macro events. And given the uncertainty, the degrees of freedom involved, the potential for the outcome to generate realized volatility across markets, all those things, all those superlatives, I think Super Bowl is appropriate. So, George, you recently published your FOMC preview entitled The Final Countdown to the First Cut. We call for a jumbo cut. As a reminder for our listeners, we're recording this podcast the day before the Fed concludes its two-day policy meeting and releases the policy statement, as well as the quarterly summary of economic projections, and then all that follows Chair Powell's post-meeting press conference. As listeners may know, George, you're one of the few strategists with a long-head call for the Fed to kick off the easing cycle with a jumbo 50 basis point cut. Tell us about the call for the 50 basis point cut, but more generally, what you're expecting from the meeting.
No, thank you, John. And I'll start with the meeting expectations, then I'll give the rationale and why we've had and maintained that 50 basis points is the right move for the first cut. But I think it's important to take a stop down here and notice that this is truly going to be a different easing cycle than what we've experienced in the last few instances. The last couple of easing cycles, they were born out of crisis periods around the pandemic, around the financial crisis. Even you could argue the 2001 was kind of reacting in a very delayed fashion, reacting to the dot-com bust. And so this is really like the quintessential kind of macro Fed cycle, things that even I haven't seen. I think you have to go back into the 1990s, early 1970s, 60s. This is a Fed that overstayed with the higher for longer, in our opinion. And now the consequences of the long and variable lags have really come to shore, and they've hit the labor market, and it will continue to do so because the Fed policies operate with these massive lags. And so this is really a different environment that most people are expecting. Something has to break, something physically that's visible that you can kind of reconcile. Why are they cutting? Why would they even contemplate cutting it at 50 basis points? And I think that's really the challenge here, is that we haven't really experienced one of these more normal macro to Fed reacting to the economic outlook, and that's what's really different this time. And and let's not forget, the Fed is also joining a lot of its other peers that have already gone through this process, and like other central banks around the world, seeing their economies decelerate, have been reacting to those sort of factors as well. So that's why I think it's so important to kind of set the stage with that at the start. For the meeting itself, we are in that negative 50 basis points as the first move. I think Chair Powell will communicate that they're catching up, that they're looking at the totality of the data. They're not going to be swayed just by slightly better NFP or not as bad or higher inflation. I think that's not going to matter. They're going to now really think about the general trend of where the economy is going. So I think that's going to be the messaging, and that they don't want to see further cooling in the labor market. That's not their intention. They've at least got inflation on track to get towards their target, even if it takes a little bit longer. They don't want to jeopardize and have it come at the expense of the labor market. And that's a really powerful message. I think he can do it. I think it's going to happen. They're also going to release their updated forecasts. It's a quarterly Fed meeting. So we're going to get updates on their infamous dots, the interest rate forecast, or the interest rate projections, I should say, in the summary of economic projections. We think that the Fed can lean on a hawkish cut 50 because they are playing catch up. They should have cut in July, which was our initial kind of forecast. I think they realized that the data's gotten worse over the course of the summer. All the revisions that we've been highlighting on the jobs data, overstating how strong the economy truly is. I think all of that kind of processed. We heard a very dovish Jackson Hole, the Powell pivot from there forward. So they can try to temper that big shift now towards an easing cycle by not completely laying out how it's going to take place. But the clock is ticking. There's only 3 meetings, including this one, until the end of the year. So if they have 3 or 4 cuts, maybe 4 is probably still would not be viewed as dovish because there's only 3 meetings left. And if they did 50, that would imply 2 more 25s. And then probably no major changes to the pace of 2025 or later, perhaps maybe pull in a little bit just because the cuts taking place in the third to fourth quarter of 2024. So I think there's a way to communicate this without being disruptive. As you said at the open, the markets have now priced this in, and historically the Fed, it doesn't like to go against what's being priced into the market, not because it's being driven by the market. They just don't want to disappoint and create unnecessary tightening of financial conditions. And that's really the big one here, because now that the market has 50 basis points and other markets have keyed off of this, like equities, credit, mortgages, other markets are looking at the rates market saying, hey, the Fed's going to do 50. If they don't do 50, why cut to begin with? Because you might actually, if you only do 25, you might actually create financial conditions tightening, which goes against the whole point of easing to begin with. And they're starting off their risk management with the first cut. So I think that we're pretty we have high convictions of why they should be doing it. I mean, there is the risk that they don't cut 50, that they deliver 25. Most surveys, most forecasters, like we're one of the few strategists, if not there's a handful or a couple out there that are calling for a 50. We've been having this view for quite some time. We didn't change it over the course of the last week and a half, and now the market's pricing it in. It's possible they do 25 because the broader investor community, or at least what's coming out from surveys by investors, what we're seeing in the news media, that there's kind of a bias towards 25, so it doesn't seem like something's wrong. I think that's the wrong approach, and I think that the Fed's going to see through any sort of the optics that a 50 creates by being very clear that there's a policy reasoning for this. They're far from neutral. Real rates are very high. They can front load this and potentially do less cuts, which would be a good thing if they can get ahead of this and not allow a recession to really take hold or a weak environment. And it's partially priced in, so why surprise? And labor market, clearly, I think it's now well embraced that labor market is decelerating. And if you strip out government and cyclical or non-cyclical job growth, there's very little of it. And there's a risk that September NFP could come in very low, if not negative, given layoffs as well as the birth death model seasonality. So there's so many reasons why they should do it. I think they're going to do it, and we'll see how that goes.
Yeah, the repricing of the forwards over the last week or so, kind of as already discussed, has totally been eye-popping, and a ton of good reasons, as you said. At this point, the market's giving them it, and it's an interesting idea that you're kind of pointing out there, that they could kind of deliver a hawkish 50 by cutting 50 basis points but then not signaling as many cuts in the future, and obviously Powell has an opportunity to wordsmith this a little bit. So as I've heard you say many times, and a well-held view, his press conferences tend to meander in a dovish direction at some point. So it'll be interesting to see how that plays out. But why don't we do this? So that's a very comprehensive discussion of what to expect tomorrow, or rather today, for those of the listeners who are listening at the day the Fed announces its decision. But inevitably this particular meeting comes and goes. And then at that point, the debate moves towards, what kind of easing cycle are we going to see? What's the neutral rate? So just stepping back more generally, let's talk a little bit about this rate cutting cycle, perhaps, how the economy evolves and the interplay there. And why don't you share your latest thoughts on all that to our listeners?
Yeah, I think this is really where the rubber hits the road, because they're going to ease 25 or 50. We're in the 50 camp, but it sets in motion a process. And the process is, you usually, when you embark upon an easing cycle, you don't take this kind of stop-start approach, especially the Fed. And so I think the goal and the intent is to get towards neutral. And if we need to go beyond neutral because the economy is decelerating, they won't stop there either. So we have to be open-minded to that. So, but the problem is, most forecasters, and the Fed included, we don't know what neutral is at any given point in time. There are estimates of what neutral tends to be. There are their forecasts, which is the long run dots, which is somewhere around 2.75. And perhaps neutral is higher now. The world is a little bit more inflationary. At least it has become inflationary post-pandemic, but it could quickly swing the other way with all the developments and investments in capex around AI. So I think the jury's still out if real rates are or neutral rates are much higher, and therefore real rates are higher too. But we don't know. So let's just say it's somewhere between 2.5 and 3.5 for at least the first point. It's elusive, it's period specific, but it's definitely not 5.5. And so they're starting from a high point of 5.5 at the upper band. They got to, our view, and it has been our view for quite some time, they're going to cut at a minimum 200 basis points. That's been in our forecast on a rolling basis. That gets you closer to some version of neutral, and then we determine. Yeah, it's quite possible, though. There is an election in between that could impact fiscal policy along the way, and perhaps that could result in less cuts too. We shall see. But I don't think the Fed's going to wait around and see how Washington D.C. puts his policies in order before they start to really address what the economy needs. So at a minimum, you're talking about 100 this year, if not more, and then another 100 next year, and probably early on. If you go back historically and you look at easing cycles are quick. They don't drag on for many, many years. And when they do, they're mostly tweaks. Like in the 2001, 2003 cycle, the last 2 years were 75 bips of adjustment roughly, but the bulk of the easing took place in the first 12 months. So if it starts now, it's going to be pretty much over with by the summer of next year, if not sooner. So we are in the front loading camp. Get it as much as you can, and then assess the economy and how it's doing. We'll see fiscal policy, how that works. But again, it's too early to have a definitive path because we have the election in between. The economy may evolve in a different way. The global economy might impact how things shake out as well. So there's going to be multiple paths. I think you have to be open-minded to the idea that neutral. We kind of we've seen the rates markets price towards the neutral around 3. It might get there faster, or it might drag out longer if we have some sort of any good news in between.
Okay, great. Yeah, I think, I guess I would point to your piece and encourage our listeners to read your FOMC preview, which again is entitled "The Final Countdown to the First Cut." We call for a jumbo cut. All the stuff that George kind of highlighted on the podcast, but a lot of good charts, which are kind of helpful, for those of us who are visual learners like myself. And if you are still not receiving George's strategy reports, check out the MUFG research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as sign up to have it conveniently delivered right into your inbox. Great stuff as always. Thanks, George.
Thanks, Sean. Good luck, everybody.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.